Welcome back to the Daily Crypto Roundup. It's another frustrating day for traders. Here's what we're covering across the market as we head deeper into the week. Bitcoin is holding steady but cautious just below key resistance. Ethereum is attempting to stabilize after last week's volatility. XRP is seeing renewed optimism on legislative hopes, and broader market sentiment is shifting from outright fear toward controlled positioning. This isn't a breakout environment, but it's also not panic. It's a pause, and today's stories reflect that shift very clearly. Before we dive into the day's stories, let's orient ourselves with where the largest coins are trading right now. Bitcoin, still the dominant store of value in crypto, is changing hands around $88,400 and showing only modest moves as traders sit on the sidelines awaiting macro clarity. It's up slightly on the day but still range-bound below key resistance. Ethereum is trading near $2,975, reflecting a mild bounce after recent volatility as the network's ecosystem activity quietly steadies. Binance Coin sits just under $890, maintaining its role as a core exchange-linked asset, while Solana is around $126, consolidating after earlier strength in its DeFi and throughput narratives. XRP is around $1.90, stabilizing after snapping its losing streak as legislative hopes return to the conversation. Cardano and Polkadot are range-bound, with ADA near 36 cents and DOT just above $1.85, mirroring broader market caution, and meme and utility assets like Dogecoin are trading with subdued volume near 13 cents. Across the board, the top 10 coins are in a holding pattern rather than directional breakout mode, highlighting both lingering uncertainty and the market's resilience in defending key support levels. One of the clearest themes today is adoption quietly continuing underneath the surface, even while price chops sideways. New data circulating across U.S. business surveys shows a growing number of merchants now accepting crypto payments at checkout. This isn't being driven by hype or meme cycles. It's coming from payment processors integrating stablecoins, Bitcoin, and Ethereum rails directly into existing systems. The trend is subtle but important. Crypto isn't being pitched as a speculative asset in these cases. It's being treated as a payment option. That's a long-term structural shift, and it's happening regardless of whether Bitcoin is up 5% or down 3% on the week. At the same time, Bitcoin itself remains locked in a waiting pattern. Price action today has been subdued, with Bitcoin stuck just below the 90,000 level as traders look ahead to upcoming macro signals. There's no shortage of interest. What's missing is conviction. Market participants aren't willing to push price aggressively higher until there's clarity around interest rates, inflation data, and broader risk conditions. And that hesitation is showing up clearly in derivatives data, spot volume, and funding rates. Vikram Subburaj, the CEO of Giottus, summed this environment up neatly in commentary published earlier today. He said that after a week of volatility, Bitcoin's rebound toward the upper 80,000 range reflects cautious positioning rather than renewed bullish aggression. According to him, traders are waiting for clear macro signals before committing to directional bets. That framing is important. What we're seeing right now isn't weakness, it's restraint. And restraint usually comes after leverage has already been flushed from the system. That same theme was echoed by the CoinSwitch markets desk, which noted that traders are positioning conservatively as they wait for guidance from the Federal Reserve on interest rates and inflation. Their view is that the current setup shows limited conviction for aggressive long positions until macro clarity arrives. Again, this reinforces the idea that the emotional selling phase is behind us. Fear is still present, but it's no longer accelerating. The market is thinking again, and that's always a meaningful shift. Ethereum, meanwhile, is attempting to stabilize after a turbulent period. Price has rebounded modestly, pushing back toward the high 2000s, and short-term sentiment has improved slightly. Some commentators have pointed to renewed interest in Ethereum's ecosystem as gas fees stabilize and Layer 2 activity continues to expand. But it's worth stressing that Ethereum's recovery so far is technical rather than narrative-driven. There hasn't been a single dominant catalyst today. Instead, it's benefiting from the broader market's refusal to continue selling. Analysts are watching key levels closely. Riya Sehgal, a research analyst at Delta Exchange, noted that Bitcoin is facing stiff resistance between roughly $89,000 and $91,000, with support around the mid-80,000s. She added that Ethereum is mirroring a similar structure, capped near the 3,000 to 3,050 range, with major support around 2,800. These levels matter because they define whether this market remains range-bound or begins to trend again. Right now, we're still firmly in range territory. XRP has also found its way back into the spotlight today, snapping a losing streak as optimism builds around US crypto legislation. Price action has stabilized, and sentiment has improved as investors speculate that upcoming regulatory clarity could benefit assets with established institutional narratives. XRP, for better or worse, sits right at the intersection of crypto and regulation, and any hint of legislative progress tends to show up quickly in its price. That broader regulatory conversation is becoming harder to ignore. Crypto is no longer a sideshow at major global forums. At Davos and across policy discussions in Washington, digital assets are being treated less like a novelty and more like infrastructure. Draft market structure proposals, stablecoin frameworks, and digital commodity classifications are all moving through various stages of discussion. None of this translates into immediate price pumps, but it does change how institutions think about exposure. When the rules start to solidify, capital becomes more comfortable waiting on the sidelines. This is where macro and crypto continue to intersect. Akshat Siddhant, lead quant analyst at Mudrex, pointed out that Bitcoin has successfully defended support around the mid-80,000 level, hinting at a near-term recovery attempt. He noted that fears around potential US government shutdown risks created a brief risk-off move, but sentiment improved as the dollar weakened. That's a crucial point. Crypto didn't rally because of good news. It stabilized because uncertainty eased slightly. That's often how turning points begin. Another key story today is the growing conversation around stablecoins and their impact on traditional finance. A major warning circulating from global banking analysts suggests that hundreds of billions of dollars could eventually flow from bank deposits into stablecoins over the coming years. While timelines vary, the implication is clear. Stablecoins are no longer just tools for traders. They're becoming alternatives to cash, programmable, borderless, and increasingly integrated into payment systems. This matters because stablecoins act as bridges. They allow institutions to interact with crypto infrastructure without taking direct exposure to volatility. As that bridge strengthens, it becomes easier for capital to move into and out of the ecosystem without friction. And once friction disappears, participation tends to increase, quietly at first, then suddenly. Michael van de Poppe, an independent analyst widely followed in the space, commented today that Bitcoin's recent correction should be viewed more as a positioning reset than a structural breakdown. He argued that short-term support losses increased volatility, but the underlying market structure remains intact. According to him, what we're seeing is rapid repricing in response to macro uncertainty, not the beginning of a new bear market. That perspective aligns with on-chain data showing long-term holders remaining largely unmoved. Volatility, however, is not going away. Macro events continue to stack up, and traders are well aware that liquidity conditions can change quickly. Another analyst quoted today highlighted that upcoming GDP data, Federal Reserve commentary, and broader economic signals are likely to keep volatility elevated in the near term. In other words, even if downside pressure has eased, the market isn't entering a calm, linear climb. Expect sharp reactions, fake-outs, and rapid sentiment shifts, especially around key data releases. So what does all of this mean if you're listening as a retail participant, not a trader glued to charts all day? It means the market is transitioning from emotional to analytical. Fear hasn't disappeared, but it's stopped intensifying. Price isn't flying, but it's holding. And underneath that surface calm, adoption, regulation, and infrastructure continue to move forward. This is often the most frustrating phase of a cycle. Nothing dramatic happens. There are no headlines screaming all-time highs or catastrophic collapses. But historically, these are the periods where positioning quietly resets, narratives rebuild, and the foundation for the next major move is laid. Whether that move comes in weeks or months is impossible to know. But the conditions that precede it are beginning to form. As we wrap up today's roundup, the key takeaway is this. Crypto markets aren't panicking anymore. They're waiting. Waiting on macro clarity, waiting on regulatory signals, and waiting on liquidity to decide its next direction. Bitcoin holding support matters more than Bitcoin pumping. Ethereum stabilizing matters more than short-term volatility. And the fact that institutions are still talking, building, and integrating while price goes sideways is arguably the most bullish signal of all. As always, we'll keep tracking the data, the narratives, and the signals beneath the noise. If you're holding, stay patient. If you're watching from the sidelines, stay informed. Like and follow for the next update, and as always, we will see you at the top.